A business transaction can be defined as a business exchange in which each participant receives and sacrifices a value. It's a business's interactions with other businesses, customers, vendors, and others with whom they do business. Most business transactions for buying and selling goods and services are either cash or credit transactions. Cash and credit transactions can be sales or purchases. Sales and purchases are opposite sides of the same transaction. By that we mean one organization's sale is another organization's purchase. Cash sales and cash purchases are straightforward. It's where payment is made immediately. In accounting, a cash transaction does not literally mean payment with notes or coins. Cash transactions for accounting purposes means immediate payment or prepayment. So for a cash transaction, a buyer chooses the goods they wish to purchase, immediate payment is made, and a receipt is then given by the supplier to the customer. Credit sales and credit purchases, on the other hand, is where credit is offered. It's where payment is made later than the delivery of goods date or provision of service date. This means credit transactions are more involved, requiring more documentation. Some examples of business transactions are purchases, sales, employee payments, petty cash payments, raising finance, and tax payments. Purchases is the buying of inventory for the purpose of sale in the ordinary course of business. Purchases can be for cash or credit. Sales of goods or services refers to the income generated from the business's main activities. In accounting, sales can also be referred to as turnover. Again, sales can be for cash or credit. Employee payments such as wages and salaries. Petty cash are an organization's small cash payments. These payments should be supported by petty cash vouchers. Raising finance, for example, through owners' capital investment or bank loans. Owners expect a return on their investment, usually a percentage of profits, while banks expect interest to be paid, as well as the repayment of the original loan value. Tax will be paid in response to tax authority assessments. Receipts or payments are an organization's inflow or outflow of money, usually because of the previous types of transactions. Like sales and purchases, receipts and payments are opposite sides of the same transaction. One organization's receipt is another organization's payment. A business transaction is an organization's economic activity, and all transactions are recorded in the organization's accounting system. Each business transaction is represented by a different type of documentation, utilization of which depends on the organization's procedures. A source document is proof that a transaction has actually taken place. Business documentation is used to record a transaction, control the progress of a transaction, and provide the history and proof of a transaction. Documentation can arise internally or externally, and nowadays can be handled using computer records as well as paper records. Some forms of documentation are required by law to substantiate an organization's financial statements. For example, taxation authorities require invoices to be retained by a business and properly filed for future reference for a certain period of time. With so many people and different types of transactions involved in running an organization, it's important to ensure all business transactions are properly controlled. This can require only authorized employees entering into certain transactions. Examples of this would be only a department buyer being able to enter into a transaction to buy goods for the organization, or only a sales assistant being able to make sales to customers. Also, procedures for carrying out transactions must be in place and followed correctly. Examples of this would be the use of tills to record sales. Each time a shop assistant makes a sale, the sale amount must be entered into the till, with the money received also being placed in the till. In order to properly control business transactions, an organization will usually have a variety of internal checks and controls in place to pick up any fraud or errors that have been made. Some examples of internal checks and controls include reconciliation of cash received to till roll receipts, reconciliation of petty cash amounts to petty cash vouchers, reconciliation of cash records to bank statements, check or petty cash authorization, or invoice payment authorization. For your exam, you are not required to know the definitions of each type of document. You are required to know what types of documentation there are, the reason for their use, and the content you would expect to see in the various documents. The style and name of documentation may differ from organisation to organisation, but content requirements will only vary slightly. A quotation, issued by the supplier to the customer, is an estimate of how much something will cost. Quotations are used as a price estimate on a commercial project or transaction and are issued in response to a price inquiry. A price inquiry may be a formal written document, or it may simply be a telephone inquiry. Quotations should be authorised by an appropriately trained individual with care taken when quoting prices, as acceptance of a quotation by the buyer can form a legally binding agreement on both parties. It is best practice for a company to request quotations from different suppliers. This ensures the best price is being achieved. Quotations usually contain the following details: description of goods, price including discounts and other benefits, delivery schedule and period of validity. A purchase order, issued by the customer to the supplier, is a buyer-generated document that authorises a purchase transaction, used to control the purchase of products and services from external suppliers. Purchase orders indicate type, quantity, and agreed prices for products or services. It may be a formal written document or a telephone purchase. A purchase order constitutes a legal offer to buy products or services. An acceptance of a purchase order by a seller forms a contract between the buyer and the seller. A sales order, issued by the supplier to the customer, is a document used to confirm a customer's order. Sales order confirms quantity and types of goods and services, date of supply, location of supply, price and terms. A delivery note, issued by the supplier to the customer, is a document accompanying a shipment of goods that lists the description and quantity of the goods delivered. There will normally be 3 parts to a delivery note: a customer copy, a signed proof of receipt copy returned to the seller, and a signed copy for the delivery organisation as proof of delivery. An invoice is a demand for payment. Issued by the supplier to the customer, it is an itemised bill for goods or services provided, containing individual prices, total charge and terms of sale. An invoice identifies both trading parties and lists, describes and quantifies items sold. From the seller's point of view, an invoice is a sales invoice. Details must be accurate. Price, quantities, discounts, sales tax calculations and customer details should all be checked prior to issue. From the buyer's point of view, an invoice is a purchase invoice. Invoices should be checked against relevant purchase orders and delivery notes. This ensures that only goods ordered and received are paid for. Other items that should be checked are pricings, discounts and sales tax calculations. A credit note issued by the seller to the buyer is a form or letter stating that a certain amount has been credited to the buyer's account. It is the reversal of a previous invoice or part of an invoice. To help prevent, detect and correct fraud and error, businesses must keep strict control on the issue of credit notes. Credit notes should be authorised by someone suitably responsible to do so. For example, some companies may have the control in place allowing only supervisors to authorise credit notes. A statement is issued by the seller to the buyer. It is a document that provides a chronological summary of all transactions associated with the buyer's account during a stated period. Basics shown on statements are all invoices, credit notes, payments received and discounts for the period, together with usually a running total of the balance. A remittance advice slip is issued by the customer to the supplier, informing the supplier of payment of their invoice or bill. Other types of documentation you may come across are a receipt, which is a written acknowledgement that something of value has been received. Receipts are issued by a supplier to a customer and refer to the inflow of cash received by the supplier. A receipt is an organisation's primary source of proof that payment has been received. A petty cash receipt is a document used to record expenditure from the petty cash fund. Petty cash funds are maintained to provide a company with fast access to small amounts of cash for minor non-routine purchases. Petty cash vouchers are used to maintain financial control of petty cash accounts, preventing abuse or mismanagement of the petty cash funds. Payslips are a document given to an employee detailing the amount of pay given and the tax and insurance deductions made. Payroll is one of the largest and most regular payments an organisation has to make. A goods received note is a document the customer or receiver of goods prepares upon receipt of goods. Goods received notes are generally prepared by the goods inward department of an organisation. A debit note is a document issued by the buyer to the seller informing the seller that its account has been debited for a given reason. A debit note is mostly used by a buyer to adjust or rectify errors made in sales invoices. A debit note is often used to return goods on credit. The seller then issues a credit note to the buyer indicating that the goods have been received and that the purchaser will not have to pay for them. All financial dealings are represented by some form of documentation. A formal documentation retention policy is an organisation's policy with regards to the effective, efficient and legal requirements of review, retention and destruction of documents, files and records. Some documents may have to be retained by the organisation for around 5 to 10 years, depending on local rules. A documentation retention policy identifies documents that should be kept, identifies how long documents should be kept for, identifies documents that should be destroyed and how they should be destroyed, provides legal compliance with documentation retention law, ensures valuable documentation of transactions is retained and available to the organisation when needed, and can save money and space and time required for storing documentation. The types of documentation that may be stored under a document retention policy are financial records, which includes financial statements right down to original documentation, tax records, corporate legal records like certificate of induction, memorandum of articles, insurance records, personnel records, for example, employee contracts. Documents do not have to be kept on the business premises. The use of scanning and the keeping of computerized images of documentation is becoming more common. Data security is the protection of data from destructive forces and the unwanted actions of unauthorized users. All accounting departments, no matter what size, handle sensitive data, and whether collected externally or generated internally, data is always subject to risk. The confidentiality of certain information should be protected at all times. Leaked or stolen information could cause irreparable damage to an organisation. Growing fears that ever-increasing amounts of information about individuals held by organisations could be misused has led to data protection regulations and principles. Different jurisdictions will have more or less stringent regulations and principles. The main ones being, data should be obtained only for lawful and specified circumstances, retained only for as long as is necessary for its lawful purpose, accurate and up-to-date. Data held should not be excessive, kept no longer than necessary, and always kept securely and not disclosed to a third party. Individuals are entitled to be informed by a data collector whether he or she holds personal data of which that individual is the subject. Be informed of the purpose for which personal data is held. To have access to any such data held by the data controller, and where appropriate to have such data corrected or erased.